Mr. Chris Frostad. How are you, sir?
G'day, Matt. Very well, thank you.
I'm glad to hear it. Glad to hear it. Okay, we're winding down for the year, but we're going to have a little run through of a exercise that I see more and more as being relevant to how companies get through next year, and that is around financing. Because the amount of times I hear CEOs go, "The market is broken. It is broken. Their retail are not here for us." There's dwindling support from even institutional, which doesn't leave too many options. So people are trying to take matters into their own hands. So we're going to talk about things like partnering with seniors, prospect generation, changing up the model, trying to get some kind of revenue flowing through bulk sampling, tailings, etc. And of course, what will industry do about it? What will strategic investors do about it? And I guess a few sort of other things which used to be called alternative financing, which now seem very mainstream, which is NSR and streaming. And I'm sure there's a few other fund type ideas we can throw in there as well. But first, we better start with news of the day or yesterday. Paladin, maybe they finally got the fishing deal over the line.
Yeah, Yeah, they over the line here in Canada. Canada's been reviewing that transaction for a little while now. And they've approved everything, but there's a lot of conditions on it, and those conditions, oddly enough, are focused on China, as opposed to.
Why is that? Remind us why.
Well, China is, I guess a lot of countries, the U.S. included, are really concerned about China's control over a lot of the critical minerals, the rare earths and uranium and other things as well. And in fact, Canada. Let's see now, China. CGN, which is one of the state-owned uranium companies in China, has a fairly big stake in fission, and they've also got a 3-year offtake with fission. And Paladin as well, their Langer Heinrich, I think is at least 25% owned by CNNC, the other Chinese organization. And you go back a while, and the problem we always had with China was selling uranium to China was that if you're part of the troop here, you have to be able to differentiate where that uranium is going if you're going to sell it to another country, and you had to differentiate specifically between the facilities that were going to be accepting it for energy and those facilities that were going to be accepting it for weapons and for military use, and China would never differentiate and provide a differentiating list. So it was very difficult to sell to them. I think Australia found a bit of a loophole in that they said if we sell you X amount of uranium and we see that same amount come out the other end for energy, then we consider it okay, which it really isn't. But nonetheless, that was kind of the condition made. So I think the Canadian government is rightly concerned about China's access to Canadian uranium.
Yeah, and of course the other side of that coin is Paladin, right? They're down from the highs of $16.50.
Yeah,
middle of this year down to just under $8 now, so 50% less. So I'm guessing the terms of the deal don't change, but the cost just went up.
Oh, absolutely. Yeah. Well, yeah, but then you've also got the Canadian dollar taking it in the ear, which kind of evens things up as well sometimes. But yeah, it's still a project that requires a lot of money, the fission project, to move it forward, and there's still a lot of hurdles it has. So we'll have to see where it goes from here.
Well, I guess it's not new news, but maybe the news is it's going to advance forward for now.
For now, and again, as we're talking about M&A and talking about putting projects together and things together, it's one of the things that happened this past year that demonstrates that has to happen. It also, though, demonstrates some of the challenges and difficulties in doing that. Putting some of these things together.
Yeah, interesting. I think so. As you say, CGN's of 11-12% shareholder efficiency. We'll see what pressures that brings Paladin going down the line as well, because of that whole kind of Africa conversation around who's going to fund these projects in Africa. It seems that both of the sort of state-owned companies are sort of leaning in heavily in the share. We've seen, what they're doing down there in Namibia, and maybe some of these news stories coming through as well. So interesting. We'll put it down as interesting.
Yeah, it's
Right.
interesting. We
Okay.
talked earlier too about ISO's acquisition of Anfield, and they're having
Oh,
challenges.
well, two
Um,
bits of lifestyle news actually. Go on.
yeah,
We'll start with Anfield. Yeah, it's hard
yeah.
work. M&A is hard work.
It is hard work. It is hard, and it's not all. And again, because we're dealing with Canadian companies operating in the U.S. and doing a variety of things. You've got a lot of different players with eyeballs on it, and in that case, for a variety of reasons, you can go check out the news flow. But this one's got to go back to the Anfield shareholders again one more time. So these things take time. Well, talking about our own transaction with ISO that was, we'd hoped to see it close in September, and this morning we just announced that transaction is finally completely closed.
Bravo, sir. Well done.
So these
It's
things,
not. It takes a while. It takes a long time to do these things. But I think for you, good news, and we're going to talk a little bit about that in a second when we talk about some funding structures. But just sticking with the Anfield thing, obviously, yeah, it's got to go back to the Anfield shareholders, and they're going to have to make a call as to what stock they think is fully valued or not. Because we're talking about UEC, so stepped in here and said we need more money.
right.
So one outcome is deal stands as is. Another is the deal just got a little bit more expensive for ISO Energy, or three, UEC are posturing and maybe looking to make moves themselves. So as an investor, you got to think about the type of money that's coming in, and if there's some real upside, because not a lot of this is going to happen with a lot of cash, certainly not in this market. We shall see. We shall see what that looks like. Okay, and right. Well, why don't we leap into this wonderful topic that has been fascinating me. And I say this in the context of someone who probably sees about 300 companies a year. So I actually talk to the management of about 300 companies a year, sometimes more. We also do a lot offline as well. And I hear the same thing. Whatever exchange, doesn't matter if it's Australia, here in Europe or North America, the retail have run away. Everyone thought they were a genius in 2020, maybe even 2021, but they most of them are down on their portfolio. Their returns aren't there. They've had to admit losses, and they're hurting. They've less disposable income, less discretionary spend. Been saying that for 4 years, and now the market's feeling the full brunt, full force of this, because even the brokers are hurting. The institutions have stepped away. It's tough out there for companies, sub a couple $100 million. So, well, I should say, explorers and early stage developers. It's hard. It's really hard. What's your kind of overall sense of that kind of statement first of all, and then we'll kind of get into the weights.
Well, it is hard, and it's always been hard, and so it's which makes it even harder for investors to start picking a horse, because it is tough. And I think I threw this number out to you earlier. Was in Canada we've got about 1,500 publicly traded resource companies of various shapes and sizes, but over 80% of them are exploration companies, and with average market caps of about $15 million. And no matter what commodity you're looking for, if it takes millions and millions of dollars to actually put together a resource, how does a $15 million company do that and put that together? And so it's a real chicken and egg problem that we run into, and in tough markets like we've seen recently, it just gets harder and harder and harder. So. Yeah,
it's tough out there because the chance of success is slim, right? We've both worked in the technology space, which in many ways is much harder in terms of likelihood of success, because you're trying to solve a problem for now and the future. And unfortunately, in the tech space, the future comes running at you at a much faster pace than, say, looking for assets underground, which have been there, a few hundreds of millions of years. But nevertheless, the kind of the buying psychology with investors is the same. They're trying to make a kind of quick buck. They wanted the high leverage, high returns on their investments. But you kind of got to remember the kind of basics of investing.
And I think it's a little, the difference. And you mentioned technology, and I said this before. I mean, in mining or resources, our product doesn't have a shelf life like it does in technology. And again, in a technology investment, if I'm trying to sell that investment or pitch that investment, I'm trying to get you to believe that I believe this is what's going to happen in the future. This is where the need is. This is where the demand is going to be. This is what people need, and this is what we're going to put out there. The problem on the exploration side is it's simpler but different in that I have to try and convince you that I already have something that's of value, and before it's a resource, the only way to do that, quite frankly, and we keep crossing lines, is to oversell it. And that's the problem. So I'm trying to convince you that there is probably or could be something on the piece of ground that I'm working, and if it's there, it's a huge upside, and if it's not, it's all or nothing. So it's a different pitch, but from an investing standpoint, it's more dangerous, right? Because I think investors in technology understand the fact that they're buying into a future state, whereas in resources, they got to rely 100% on the fact that you're telling me the square goods on this thing, and it's going to be what you think it's going to be. It's tough. It's tough.
It is tough. Like, and I think from the tech standpoint, some of the brightest people I've ever met were in that space. And I've seen it as a family office investor with, we kind of focus on the enterprise software side of things, banking software, that sort of thing. Whereas the kind of like I guess these sort of 5-man bands thinking that they're going to put some widget in someone else's software and it's going to change the world. It's interesting, but it's never going to have the chance to be an economic success because somebody's going to come along and replace it with widget 2.0. It is a very different space, and in many ways, those smart people aren't kind of.
But I think the similar aspect. The similar aspect, though, is that you have to rely on the people that are running the show not to get married to their business model, not to get married to that piece of rock they're staring at. And I know you constantly will ask people that are on, what's your business model? But the fact is, I think in exploration, we have to live with the fact that we are a perpetual startup. We're always going to be a startup. And in terms of whether it's technology or what have you, you have to continuously adapt to what you're looking at. I've done so many. We did a lot of technology startups in the early days, and once you had a widget, it was the application of that technology that you couldn't get married to. I mean, we had an application that was specifically for chiropractors, for instance, and once we realized all the difficulties we were having on that, we changed it up and we started going after financial advisors or optometrists or something else. But you have to be able to dance. And I think the same is works in exploration. You have to look at the assets you've got, look at the market that you're playing in, look at the environment around you, and you got to adapt. You can't just dig your heels in and say this is it from here on. And it either wins or it doesn't win.
I think that I think the mining space is a lot easier in many ways. Finding a new audience for your one product or service, that's kind of simple. I think here we better get back to people are going to get annoyed if we're talking about tech, but I just think there's a lot of parallels in terms of investing mentality. But let's focus on explorers, right? The challenges that they have, as you say, is to continually persuade people to give them money to keep drilling because they're going to find stuff. And some do, well, most don't, but some do, and they're able to continue along that process. I think I've got to explain the reason why I ask people about business models. Again, some people, will criticize me for everything and anything I do, but when they say, well, why do you keep asking about the business model? They just got to drill. I'm like, no, you need to understand what they're starting with, what their hypothesis is about how they create that value. Don't say I'm creating value or I'm aligned with shareholders, any of that kind of generic horse shit. This is what he's setting out to do. You're either saying I'm a prospect generator, which is I'm going to find some stuff which I'm going to flip to someone else who are then going to spend the money to do that, or I am an explorer and I'm going to take it to this point in time, in which case, and then I'm going to bring someone up with a bigger balance sheet and I'm going to be free carry to whatever point in time, or whatever you think you're going to do, and whatever you are capable of doing. The amount of times that companies have gone from I'm a pure play greenfield explorer, taking it through to production is like, I show me one, please. Okay. It doesn't happen. Even if you kind of keep upgrading your boards to say that we will. No one wants to. No one wants to go on that sort of 20, 25, 30-year journey. Very few. So I want to be really clear that I understand what I'm investing into and what the thought process is, because I get that you're going to have to continually raise money, and you're going to have to try and do that at higher share price, and therefore, the cost of capital is not going to penalize you as you kind of run the stock into the ground, which again, statistically, most companies are likely to. And then, we'll have a conversation about, well, what do we like? We like management teams that have been there and done it before, not doing the theory of it. You like management teams with a track record, history of doing it. We'd like management teams with access to the financial markets, because people trust their ability to generate value for shareholders, genuinely, not talk about it. So in many ways, it's really, really, really simple. But as you say, when you've got retail investors who've got a choice of 1,500 companies, 80% or so, which are 15 million bucks or less, that's a lot of choice. And the smaller the market cap, the less capital, the more chance of failure and value destruction. And there we go, that continual downward spiral of destruction. So it's simple, but at the same time, people keep making the same mistakes. And I think that's the frustrating thing for me. Should we get on with the actual conversation? Sorry about my rant, but it's so obvious when you're sort of sitting looking in on this thing, where the mistakes are and why people get sucked in, and they, to your point, fall in love with the management team, or they fall in love with the asset, or they fall in love with the fact that they've made this investment and they're not allowed to change their mind. And those things are all absolutely going to end in a very, very bad way most of the time. Statistics back me up on that one. Funding. Companies need to find a way to fund themselves given that backdrop we've just described, where people are avoiding explorers. Should we start with what you've been doing with Cameco, with Orano, now with ISO Energy as well, which is basically partnering with seniors or strategics?
Yeah, I think, well, that's really where we are now. Our best projects are now under joint venture with companies that have far stronger balance sheets than us, have a propensity to keep looking, have a strategic need to keep exploring, and so we've got that continuity of investment, and it requires less dilution on our part. What it does require, though, is the right assets, right? They're not going to just partner with anybody or anything, and that's I think the crux of where we run into a lot of problem, because a lot of these, especially on the uranium side, a lot of it is truly greenfield. And we were able to get into another joint venture that came and went when Rio Tinto got out of uranium back in the day. But one of the first deals they did in the basin was with us, and it was on one of our projects. And the only reason they were comfortable doing that was because we had invested so much time and money into all that preparatory work that we talk about. The geophysics and some initial drilling, and we really had a real toy box of stuff from an exploration standpoint, and that's what they found interesting. So to get into a relationship with a more senior partner, you've got to recognize that they've got a very different risk profile than you do. They've got very different objectives than you do, and they're not interested necessarily in greenfield. They can't afford to. That's not their business model. They're not out there to throw risk capital into the wind. So you have to put something together, I think, of value, and then, especially in this market, the minute you can demonstrate that it does have, like, it truly has potential, aside from just happening to be in northern Saskatchewan somewhere, you got to find a partner. You got to find a partner, because it, as we've proven and shown many times, it takes tens of millions of dollars to actually find and deliver this stuff. And if you're going to do it on your own, you're trying to bail water out of the ship slower than it's coming in. We are.
True, true, true. And I think obviously you've got that with Orano, you've got it with Cameco and ISA Energy, all with
Well,
big
even
balance
with Foran,
sheets.
I'll mention, and I mean, Foran's a
Yeah,
little bit different because it's not a uranium project. But again, it
yeah.
was a project that we staked, and we quietly worked it. We watched, we waited. They were developing a mine right next door. We did ample work on it, but only enough work on it to demonstrate that, in fact, that their deposit trended right onto ours. We watched them explore right up to our claim line, but then we had something of value that we could go and negotiate with and talk to them about and bring them into the boat. So, there's a lot of project generation going on out there where it's simply a real estate play, and you wind up with weak partners. You wind up with money being raised and put in the ground where it probably shouldn't be, or in a very inefficient manner.
Yeah, but I also think the quality of this. There's another company who've done a similar thing to you called Ridgeline Minerals, and they've got deals with NGM, which is Nevada Gold Mines, which is a joint venture between Barrick and Newmont. They've also got one with South 32. So in terms of like quality of partners, like you, very, very good. And then it comes down to the terms of those deals. Is it okay? They put their money in, but what do they get for that? What do you get out of that? Are you carried? Are you carried to what point? And what are the kind of guarantees at the point where you do have to start paying your own way? Will they help you with that? Will they help you get the debt in place? Will they help you get the equity in place? Will they buy it off you? You know what I mean? So those deal structures are really, really important, because then one of the things I used to see a lot, where certainly when we first started doing this in this junior space, was coming in and having these conversations. So people go, "Oh, don't worry, Rio Tinto is involved. We've got Rio Tinto as a shareholder." Have you? Well, let's take a look at that. Yeah, they've got to spend $5 million over the next 10 years. I'm like, I'm like, no, you don't have Rio. You have Rio placing a bet with you and probably 30 or 40 other companies to get an option to kind of get access to the data, to allow them to work out whether they want to work with you as they go through. We see, do you know what I mean? So that's why I think the deal
Well, yeah,
structure is really, really important.
you're right, and that is a big component. I mean, in the case of Hook Lake and Smart Lake, we actually earned in on those, so it was a bit of a different relationship coming in. But in the case of Rio Tinto, and that's a good example, where we were optioning a property to them, we realize it's Rio Tinto, and their objectives, and they from year to year, from month to month, can change drastically. I mean, they've been in and out of uranium 3 times in the last 20 years. So part of that transaction, though, was to say, because they can park your best project, right? We've just optioned them our best project, and if the deal is, as you say, I'm going to spend $5 million over the next 10 years, well, that means they don't have to do anything on it for 10 years. And odds are they won't half the time. So, the terms in our case was you've got to spend X amount of money over 3 to 5 years, but you've got to spend so much next year, and it's got to be on drilling, not on navel gazing and. So you've got to make sure that when you get into those relationships, you're not so enamored with the fact that you've now got a logo you can put on your booth at the next show, but you've actually got the terms to carry through and make sure that you just don't get parked and steamrollered over.
There you go, and that's becomes a real problem. You sort of see these projects happening in all across Africa, I guess South America to a degree, where people are just land grabbing, right? It's like, oh, we'll pick this up so no one else can, and we'll sort of get around to it when we can, because it's not quite core for us, and we got some big things going on over here. I mean, you suffered a little bit of that with Orano and Cameco during the kind of COVID period, right? They had other things going on because they got problems with having to shutter mines, or actually the bigger projects elsewhere in the world. So again, all of these things are really, really important to as an investor understand, because if I look back to Kalaska, we've had some couple of really nice holes recently, and people are super, super excited. They were 4 years ago sitting at about 5 million market cap, and had been for well over 10 years, like done nothing. And if you're the type of investor who says, oh, don't worry, I'll be fine eventually before I die, that's great. But if you're saying, I need to understand the time frames and timelines that this may stretch to potentially, I've got to make sure that fits into part of my portfolio, which has a longer time horizon. And along with risk profile and return profiles expecting, and all of those wonderful things that you must assess as a when you build your investment portfolio. And if that sort of investment is okay with you, fine, as part of your portfolio, then that's fine. But it sometimes comes to shock to people that, well, this thing is going on, and what the hell are you doing as a CEO? You should be doing this, you should be doing that. But all the clues are there right at the beginning. And I think that would remove a lot of frustration if people kind of paid attention to those sorts of things.
I mean, and Canalash is a good example because they're like us. They've been around through the thick and the thin, and and I think they adapted as we all had to get through the last 15 years, to make sure that they had that they retained the value in the projects that they did have. And in this case, they're hitting some good holes, and they're managing to maintain that value with the markets right now. And while they are able to do that, they are raising a fair amount of money. I mean, they just raised $10 million last week. So you got to do it when you can, and it comes down to the assets you've got, right? Again, when you've got something good, when you've got something real to play on, you've really got to take advantage of it.
Well, hang on to it.
Hang on.
Be in the game to play the game.
Yeah.
There we go. Uranium's a very, very unique situation in the sense that that down cycle was extremely long. That trough was extremely wide.
Yeah.
Compared to some of the other metals, but that's the game. That's the game we're in right now. Okay, so I think we've kind of hit a few topics there in terms of that partnering, the pluses and the minuses. Anything else you'd say on the minus side?
Well, certainly, and again, I go back to the fact that you got to dance, right? I mean, you have to look at what you've got, and you've got to keep changing it up. So, explorers are in a constant state of startup, and without running back to the technology analogy, but it's you have to be prepared to adapt to what's going on around you to make sure that you can keep doing what you're doing. And
as a manager, I'm talking about investors here too, right? This is the audience listening. What do they need to do?
Well, I think they need to. Again, I think a lot of it comes down to the projects. Unfortunately, I could have found 3 other deposits in my life, but the project I'm now looking at wanting you to invest in, if it's not there, it doesn't matter how good I am at finding them. I think investors have to get better at looking at and understanding from an exploration standpoint. What, unfortunately, from a technical standpoint, what is it you're looking at? I mean, are you truly looking at a project that has the potential to deliver something mineable at the end of the day? More than now, maybe I can poke a hole through some mineralization and give you a jump in your stock price for a while. But unless it's truly something, that's going to dwindle, and you better be ready to jump off the wagon. When you make that bump. So, I think first and foremost, you really have to understand the metal. You have to understand the relationship between the commodity prices and what it's doing with equities. And you need to have a little bit of savvy when it comes down to looking at the ground that's being worked, no matter who's working it. That's first. And then second of all, and you've said this before, is you got to look at management. Do they have the ability to bob and weave? Do they have the ability to keep being creative and coming up with ways to advance those projects in a way that doesn't disadvantage investors? So, I mean, if you're going to look at a track record, that's another thing to look at is how badly have investors gotten hurt in the past, not just, how much money have they made in the past? Because there's a lot of that going on out there too.
Right. And I do appreciate this is going to be hard for retail investors because on one hand, we're saying, look at the data and make your own mind up. And the other was saying, don't fall in love with the management team because they aren't guaranteed to always get it right. And then you hear people like Rick Rule talk about, with projects that he's invested into, oh, my 10 baggers have come from companies which have, lost 50% of their value at least 3 or 4 times during the period I hold it. I, so, it's really confusing. It's really hard. So anyone listening to this, I appreciate the kind of levels of confusion, but listen to who's talking about it. Like Rick Rule will be always, and by his own admission, talking his book. He wants you to stay involved and support his investments, and he'll have a lot more failures, which he doesn't talk about, as will everyone. This isn't a Rick Roll thing.
But he does. But he does. I mean, to give him his due, he does talk about he doesn't specifically point out his failures, but he will tell you that for every big win he's got 9 he's not talking about, and that's the game. That it's like a venture fund. It's you don't expect every one of them to be, and unfortunately for standard retail investors, they don't have the ability to amass a speculative portfolio like that with the expectation that 9 of them are going to fail and one of them probably will maybe just come out even and hopefully might pay for all my losses.
Yeah.
You can't.
It's a tough one. It's a tough one. I don't want to name names, but you did send me a presentation before this with a very well-known, very well-respected individual, newsletter writer and more now. And he made some calls back in 2010, 9, 10, something like that.
Yeah.
And you look at it now and you just laugh.
Well, and it wasn't. It wasn't.
You know what I mean? It's hard. It's really hard. So just because you've been in it a while, you've got something to say, and you're very articulate at saying, it doesn't mean you're going to be right. And you're certainly not right for all investor types out there, because there are lots of different types of investors who have their own needs and drivers, etc. So when people say do your own research, it's really bloody important that you do, because you're the only one who understands your investing strategy profile. Don't just take all this other noise as information which you can use and discard, or in whatever way you want to treat it.
Mm-hmm. And to that point, to that particular individual or not.
Yes.
What they were attempting to do at the time was demonstrate a different way to look at exploration if you didn't want to take the big shot, and that was talk about project generation and how
we should move on to that now.
And how you could spread the risk, and how these companies when they get into the prospect generation mode, they're developing a project to a certain degree, and then they're getting somebody else to earn into it, like similar to what we did with the Foran situation.
Absolutely.
Only you approach it like it's a business model, and you try and do that again and again and again. And so the article we were talking about was specifically saying this is a different way to look at exploration and a different way to kind of cover yourself. And maybe there's some, logically it all kind of makes sense. And to your point, if you look at it 15 years after the fact, it didn't turn out the way that one would have expected or hoped, but we certainly now better understand why.
Come on. No, it totally did. Like I said earlier, statistics are on your side always in mining. The chances of success are slim to sod all. And I look at some of the names here and I go, well, most of them don't exist. And the ones that do are, I would now describe quite politely, as shitcoes at best, but I guess they're still around. So, the best of us are not capable of getting it right 100% of the time. So understand that. This is why, when I said earlier, have a portfolio approach to investing. And by that, I do not mean go and get 100% of your investments in the exploration profile. Break it down and go, what is the risk profile of each of these types of companies, whether that be prospect generator, explorer, co-developer, producer, royalty, quite simply, or, what I'd recommend for most retail is, because if you're not prepared to have an honest conversation with yourself about how good you are, how much time you've got, how experienced you are, how knowledgeable you are, and you're going to lose your money. Okay, you're just going to lose your money. So don't pretend anything else is to do with your skill or knowledge. It's going to be down to luck and you may have one story you should talk about for the rest of your life about getting right, and you won't talk about the 9 that you or more that you got horribly wrong. Okay, so portfolio approaches say I'm going to take different types of risk profile in here in terms of the companies themselves, if you want to go direct, or for goodness sake, most retail investors, again, the stats prove me right, is go buy into an ETF, go buy into physical, if you like that thematic, or even easier, just go and buy into the S&P 500. You're going to get, on average, for the last 30 years, 10% type returns per year. That's awesome. You double your money every 10 years. Not guaranteed, but pretty much for the last 30 years, that's what's been happening. So that's what I'd say to people coming at it, coming at investing. Just an honest conversation. Most people just don't spend the time or have the knowledge to actually do this properly. That doesn't help the exploration side of things. But
yeah, thanks for that, Matt.
Yeah, well, I'm just being honest here. I think 10-20% of your portfolio in exploration, lovely. Okay, that's nice. That should be a lot of money. If a lot more people invested and a lot more people didn't lose their money, it'd be great. But I think that's the truth, and that's why we're talking today about alternative means of funding projects. I think you've got it right. I really like that partnering model. Prospect generators, we should talk about. Sorry, I've got a couple of examples, and they come out differently. I'm going to stick with uranium. Okay, there's lots of people who do it in different metals. Skyharbour, and we've got Standard Uranium. Now, they've come into prospect generation for different reasons. Do you want us to talk through what they both do?
Well, sure. I mean, I think Standard, and again, this isn't a critique on the companies at all. We're just talking about the way they've approached the market and the way they're trying to get their projects move forward. I think Standard picked up some properties, some early stage projects that for all the right reasons look good. And they went at it the traditional way. They started raising money and putting it all on the ground and doing the promotion thing. And I think what's admirable about Standard is that when they found that wasn't necessarily working, when the markets were changing, when the results coming out of the ground weren't supporting them the way they'd hoped it would, that they kind of changed it up and they said, well, we're getting a lot of inbound calls for people looking for property in the basin. Let's pick that up because now we have experience here. So they've, they found a partner to earn in on on one of their primary projects. I think they still hold another one of their primary projects, but they also started spending some time looking around the basin, finding projects, additional projects that they could stake. It's not expensive to stake in the basin. And that they could go back. There's a lot of history. There's a lot of data to put together if you know where to find it, which they do. They were able to package these projects up, maybe spend a little money on them, and put them together in a way that they became projects that other people would see and use for their sort of entry into uranium into the basin. So that's how they went at it. And kudos for doing the dance, because many don't, many won't. They just keep trying to raise money and plug it in the ground.
I agree with you. I think well done, Standard, right? They were cash constrained out of the gate, right? I remember talking in 2019. It was always like a bit of money in, a bit of money there. They didn't have the track record to be able to go, give me $60 million, right? Arthur. And at some point, you've got to be honest, put your hand up and go, this isn't working. We need to do something different. And they did. And I hats off to John. I think they've got some good stuff. They just need some money thrown at it, right? And this is a way to protect their shareholders. And I think, good. Hopefully that works out.
I think over at Skyharbour, and I mean, they actually started this approach a lot earlier, right? They actually got started up quite a while ago now. I think it was, when did they start up? About 2012, 2013, something like that. And it was a rollout from Denison, that Wheeler River project. And that kind of got them out of the gate. But of course, the markets weren't helping with anybody back at that point in time. And they've done an admirable job of actually marching forward with that model and acquiring and staking and putting together A lot of property throughout the basin of varying degrees of prospectivity, of advancement, of where they are. And it's you look at their website, it's kind of like a grocery store. There's lots of good stuff. There's lots of stuff there, and whether it's good, bad, or indifferent, that's up to the person walking the aisles to determine. But they seem to now have got a fairly steady flow of money from that to some degree. Outside of just money going into the ground, they're picking up payments here, there, and everywhere, and equity positions in a lot of these companies. So they seem to have a much more established approach to it. They've got their flagship right now is a project that they're earning in on. I think it's a Rio Tinto project that they're earning in on. But again, they've got a lot of irons in the fire, and I think from an exploration standpoint, that's a big plus as well. You want to make sure that you've got, you're not just falling in love with one piece of real estate and poking the hell out of it. So that's the approach they've taken, and I think they've been able to maintain some stability in their stock price. They're reacting like everybody else, but I think they've done better than the average bear. That's the way they've gone at it.
Yeah. I mean, both good guys, both good companies, and like I say, the earlier stage stuff, especially as a small company, is super hard, right? And you just got to stay relevant, and you just got to think long and hard about how do you genuinely create something which should be valued at a higher rate. The market isn't doing that at the moment. I think most people put out an announcement.
Right. And I think Ath is another good example of doing the dance. I mean, they walked in, like you say, they picked up a massive land position, love it or leave it. But on the backs of that, they put together a huge bankroll, and that put them in a snack bracket that they needed to be in to actually, it gave them the heft that they needed to march into the market and demonstrate that there's going to be some value. And I think out of the gate, their value proposition was around the size of their land holdings and the fact that they were going to consolidate exploration in the basin. They definitely had also planned to do a lot of vending out of some of these projects, because it's a lot of property they've got. And they're still continuing with that to a degree, but their acquisition of Latitude gave them, allowed them to actually take a bit of a shift and now put focus on a known resource that they have, that they're expanding on, and they're able to create a different story than they maybe came out of the gate with, and that's what this is all about, is about adapting to
for sure,
the currency you got.
Yeah, for sure. No, I think the acquisition of Latitude gave them Angelac, and I think that I spoke to them reasonably recently, and they're going to put 70% of their effort and money into Angelac, because it's they're sitting on £50 million ish, and they think they can make that £100 million. That makes them relevant. It makes them extremely relevant going into a higher price uranium market. It also means that they are talking about near term in Canadian sense, producer category or super advanced category at least, advanced developer story at least, and that makes them part of the kind of North American story, the North American producer story, rather than a continual exploration drilling story, because the money drains $60 million out of the gate, and a bit more beside. They're going to be down to the last 15-20 million bucks the end of this quarter, I suspect. What do you then do? You got to go and raise more money, and then we get into a different sort of conversation and a different sort of profile, and the story is aging a bit. So I'd like to, and it kind of falls nicely into this sort of the next category, which I want to talk about. And everyone listening will have their own examples of this, which is change up the business model, right? So we've got I spoke to a company. I'm losing my mind. No, old age and too many companies. But there's either this week or last, Vista Gold, right? And they've got a very big project, but it's also got, it comes, and they're 100 million market cap or less company. They've got a capex of just over $1 billion, according to their last economic study, and the market's gone no can do ski. That's not a happening. And if you do, what the heck do we do? Because even if you manage to get a 60% debt package together, what does that look like? Well, it's $400 million on 100 million market cap. It's not happening. So what they've said, if we're gonna change the economics around here. We're going to do a smaller economic study, start smaller, and look at 400 million market cap, which is still tough. It's not nothing, but it makes them 150,000.
You're talking about market cap or NPV on there?
No, I haven't talked to NPV yet. The NPV is about 1.5 billion, but I'm talking market cap of sub 100. It just doesn't do anything. But to be a 150,000 ounce producer with margins as that will do for them, it kind of makes it more doable and more likely to be able to raise the capital, and changes the kind of psychology around that project. And I respect that type of change, and say we gotta go with the Aussie model. Let's try and work out how we get this thing going. Personally, I think they could have gone even smaller, but there we go. And then we've got another kind of gold example, which is like Cabral Gold. They've been banging on about district-wide potential for 15 years, and they've had peaks and troughs. People kind of sudden interest, then not, and sudden and not. And what they've worked out is we're never going to be able to kind of realize that district-wide potential with a balance sheet like ours. Now they've said, okay, I don't want to maybe bring in a senior and partner with them, or get a strategic in and kind of give away half the upside, or do an NSR and give away future upside. They said, look, we've got some, mud at surface, effectively a blanket, which has got, 1 gram per ton up to, 5 gram per ton type stuff in there. Not a lot of the 5 gram, mostly 1. We can heap leach the heck out of that. The capex could be tiny, I don't know, say $20 million, but we could generate ourselves a ton of money each year to get after that district-wide potential. So again, that change of thought and model works in gold. I don't think that's possible for clearly necessarily every single time uranium.
No, but it does work in gold, and we did that back. I think you're familiar with Minera Alamos there down in Mexico. That was a company I was involved with for some time, and again, the projects that we inherited, the attitude is typically, or the tendency is to go big, show it as big as you can. When in fact, because we had a team of engineers that had built gold mines before, and were very good at it, we found that by making it smaller, making it more bite-sized, you de-risk it considerably, and you make it financeable again. And that was an approach that made sense. And they've since been they're financed now primarily through Osisko, but it was because of that attitude that they could go out there and actually just start building mines. And they weren't these mega stupid projects that were impossible to finance and probably would never get built.
I love it. Mega stupid. Like a mega pint. I want a mega pint of beer.
And get stupid. Yeah.
And then get stupid. Yeah. Very good. And so in that sense, we've seen a little bit where we talked about, AFA sort of changing the model or evolving the model. I don't think it's changed. It's kind of a sort of, as they learn more, and I always say this in investing, if information changes, you've got the right to change your mind. I think most people don't bother doing that, but you should. And the same with management teams. If the information changes, as you said, either, it's kind of drill to kill mentality. If it's working, keep doing it. If it's not, just please stop.
Well, and investors need the same attitude.
Yeah.
Right. You can't just cling on to something because you buy. I mean, it's certainly a lot harder to sell a stock than it is to buy it. But yeah, I mean, you've got to be honest with yourself as to whether this works for you or not, whether it's keeping you up at night or not.
Well, you found yourself ranting like a lunatic on chat rooms. Just go, this does not represent who I am. However, I've seen that so many times.
Let me apologize in advance. Yeah.
Oh, I get a few of those. Like, okay,
oh, I get, we get our
death
share.
threats, sure.
Yeah.
And we've had people saying, hey, I don't know what you're talking about, despite, pumping out a 50-page, 60-page
Yeah.
analysis of a company,
Please quit
it,
listening.
you do, yeah, they're not going to. It's just kind of pointless. They don't want to listen at the time. No one wants to hear that they're cross-eyed, boss-eyed, or not funny. But
Yeah.
it is the case that people do eventually kind of wake up, a year or so later, 2 years, and they are some of them, very few of them, kind enough to apologize, and I think that's quite nice. It gives me hope and faith in humanity out there. All we're saying today, and I think we're advocating today, is, as we've said a few times, be honest with yourself. Be honest about the type of investor you are, and be honest about what does and doesn't constitute risk for you. If you can afford to lose it all, crack on. Most people can't. But if the sooner you work that out, the sooner it'll adjust the type of investments that you do. Okay, so sorry to be preachy today, but I do see a lot of people losing money. And it's your money, folks. It's no one else's money. The guys in the chat rooms, they're not really your friends. They've got their own agendas. They're all nice people, but they will invest differently from you because they've got different life stories, stages of life, demands, etc., and pressures, blah, blah, blah. Okay, so that's all we're saying in today's session. No one gets it right all the time. Right. The other so change the model thing, I think is super cool to see when management teams do it, and investors please do that too. Bulk sampling tailings. We've had a good chat with a couple of weeks ago with Magna Mining. They did a little bit of bulk sampling along the way, which had a good chat with Go Gold. I mean, they're quite frankly, their G&A and plus some is covered by they've got this sort of tailings processing they've been doing for last 6-7 years, maybe more, down in Mexico. It's super. I kind of like those little things that you can do around the edges and say, well, that might make a difference. That 2 million here, 3 million there might get us to the next stage.
And that's funny because I mean that approach has been around for a little while, where they're going back to these old projects and reprocessing tailings now that gold isn't $300 an ounce anymore. And I think there's probably a lot more opportunity for that out there than people have focused on, because it's a kinder, gentler, simpler, cheaper way to extract metals.
You kind of think
sitting there waiting.
But I see companies that don't. They're sitting there with a bunch of tailings and an old plant, or so they need to, but they can't even raise the $5 million to kind of get. And
it seems to be less interesting from an investor standpoint for some reason as well.
But it doesn't matter. What it does do is solve for the problem of how the heck do I reduce my actual need to raise money for G&A, let alone growing the company by doing something useful. So I think it's a slight distraction. You might go, well, that's not a big prize. No, but neither's going out of business. That's not good either. So if it's something that may save a company or allow a company to move forward a little bit more slowly, less efficiently, I'm like, I'll take that option. So right now I'm losing my money.
I can tell you where there's a lot of gold sitting in tailings right now. It's in northern Saskatchewan. The gold grades, we've seen it when we drill zingers. The gold grades coming out of Cigar Lake and MacArthur are huge, but you wouldn't want to wear that on your finger. It needs a little bit of different processing and maybe a few million years to calm down before you want to actually turn it into a bar. But no, and they were
the sickness and health. Are you sure?
Yeah, they've looked at pulling the gold out of that stuff as well, but it's
interesting.
It doesn't make economic sense.
Okay, not even in electronics. No, I guess it doesn't.
Yeah. Hold it up to your ear. That's what you want.
Yes, please. Yes, please. Did someone say tumor? Yeah. Right. Okay. And then I tell you what. Here's a story. Right, and everyone knows the story who's on this platform. We do a little battery show with Mark Selby. Right now, man, there's a metal which had been through the ringer. It's been up and down and sideways, and geopolitical aspects of uranium fascinate me, but crikey, nickel comes a close second. $100 million company again, but here they are having to piece together effectively $2 billion. You're like, what the, how the, who the, how, just why, so he's a smart guy, knows the sector extremely well. I think he's a Mr. Nickel, isn't he, really? um I know a lot of CEOs in the space. They listen to the show because they want to understand Nickel a bit better. But what he's done is sort of look to government and taking advantage of the very situation. I mean, Canada's a sort of bonkers government, but at the same time, this if you're in the kind of green metals thematic, maybe it's not a bad thing for you that you can't access credits, and all sort of government financial initiatives to help Canadian mining businesses in the green metals to move forward, and even on this carbon, in this case, also carbon sequestration, this net zero target that the world seems to have set itself. But the point is, you've got to really think outside the box. And also in his case, Agnico Eagle, you've got is it Sumitomo in there as well. And more recently, I think you referenced earlier, some First Nations money. It's the first time I've kind of seen that.
Yeah.
That's like a wow.
Well, there's a wow, and a lot of these communities, a lot of these First Nations groups have got money. They've got significant amounts of money, some of them, and if you if you approach them right, I mean, and they do want to be involved in a lot of this stuff, and this is a way to get them engaged. And I don't know what did Mark picked up, like 20 million? Was
20 million? Yeah, 20 million.
Yeah,
hard cash.
Yeah,
hard
and talk about being aligned with the community you're mining in amongst. Nothing better than to have them as actual, investing partners.
Yeah.
It's brilliant, and it makes more than just the money. It makes a lot of things move a lot easier, for sure.
Mm-hmm. Very joined up thinking. So well done to companies like him. I think that's a kind of rarity in the space. You do see it, but it's rare as hen's teeth in reality. So well done him, and he's with us tomorrow. And then I sort of and I say strategic for me, and industry and strategic are really important because, and tell you why. It makes someone smart who knows the space, who knows mining, in terms of operations, with a big balance sheet to boot, have said, oh, this works. There's an approval. It's not just an endorsement, it's kind of an approval of what is in front of them in a way that's better than brokers, that's better than bankers, that's better than, enthusiastic newsletter writers.
Right, because their upside is they're actually being something there.
Well, those guys,
as opposed to earning a fee along the way.
There you go. There you go. So brokers, bankers, newsletter writers, they're incentivized because they get paid to say nice things, right? Whereas industry is like, is this going to work for me or not? If it is, I want in, right? Which is again slightly validation. It's absolutely
a huge validation, and it makes it very easy for the likes of me to talk to an investor. I don't have to now explain to them the interests, the technical aspects and geology of what it is I'm doing. All I need to say is, well, Cameco thinks it's worth throwing money at, or ISO thinks it's worth throwing money at. So they're not stupid people, and they've got no upside in investing in something like that unless they think there's the technicals are all in place. So it makes the conversation easier, and it makes it, I would think, for an investor, it makes it a lot more comfortable.
Yeah, and I want to kind of distinguish between because there's a subtle difference here between seniors who are other miners who may want to option the property and get the data to sort of see if this could be something, which is an endorsement, of course, and maybe someone downstream, a strategic downstream, like a battery manufacturer or an OEM car manufacturer as well. They have very different risk tolerances. They also have slightly different knowledge base. I say the car manufacturers don't know much about mining. I would say that, but they have talked themselves into the position where they believe that this thing will get done because they've spoken to some people. So other people said, whereas the Oranos of this world is like, okay, we mine and we process to a point, um, in this space. There's a kind of we end up at the same place. It's a big proper endorsement, but they come at it from different angles. I suspect. I've got two more. Do you mind? Have you got time? You got time?
Yeah, I could hang
Come
in
on.
here for a while.
Oh, well, thanks very much for the sheer bloody enthusiasm. Christ. Right. NSRs and streaming. Like I said, it used to
Yes.
be called
Yeah.
alternative financing, and now it's fairly mainstreaming. Mainstreaming. There's a joke there somewhere. So people used to say it's sort of a funding of last resort because they felt like kind of give away the upside, and a lot of investors do feel that too. It's like, why would you give away 2, 3, 4, 5? I've seen as high as 7% of the net um, at the other end of this? Well, because we're desperate and we've got no one else offering us money. I do remember that in 2012, 13, and 14. It was very, very popular, along with convertibles, which was what we
Hmm.
offered people. Um, so it kind of feels like in times like this, maybe NSR and streaming will find it a little bit easier to kind of do business.
Yeah.
Do you
There's a
think?
few things I would say about that. I mean, first of all, most royalties or NSRs don't come from them being sold or bought by somebody. I mean, the whole notion of them, I think, was really invented ages ago. When if I'm going to sell you my exploration project or my early stage project, I have no idea of the value of it. So how are you and I going to do you want to buy it for $1 million or $10 million? Because I think it's worth 10, and you think it's worth nothing. So the notion of tacking a royalty on it meant that the seller was, never looked the fool for having given away the golden goose. And so when you look at royalty companies running around buying up these royalties, that's typically what they're buying up are royalties that were placed on this thing ages ago when it was, passed on from one person to another. The other problem with selling a royalty too early is because you're not going to get the value of it. I mean, a royalty is the value of a royalty today is, it's simple to do the net present value of what's coming down the pipe. And if you do it too early, you've diminished the values of it considerably. On the other hand, though, I don't think investors should necessarily be concerned about royalties, like a 2% royalty, because if your project can't withstand a 2% royalty, you probably shouldn't be building it because the commodity price waves around in that far more than 2% on a regular basis. So it's it really isn't as dramatic, I think, as people want to make it out to
Well, let
be.
me give you an example. So, RNC Minerals then became Karora Resources, right? They started with the nickel project, then on to gold. Um, on one of the properties on the land package that they had a 7% royalty on the gold, and that was put in place when it was a nickel company. Then the gold became obviously gold was going to be the salvation for the company, and they had to renegotiate with Mavericks, and I think they went from 7% down to 4%. Now, in a gold price environment of about 1600, that did matter because that was the difference between them being profitable and mining at a cost, i.e., they made no margin, right? In today's gold price environment, as you say, it doesn't really matter. It's high margin. We're making some people, $1,000 on well, $1,200 on average across the world at the moment. It doesn't matter, but I think you've got to try and negotiate the royalties. Matter at certain margins, and they don't at others. I think we need to understand that. And on average, where will those margins be?
And I think to pull this back into the uranium space, one of the issues in the U.S. is that, as I mentioned before, the Department of Energy is sitting on a lot of resources, a lot of uranium reserves. The problem with them is that there's massive royalties sitting on them, like upwards to 15-20%.
Ouch.
And that's the biggest holdback on these things getting developed or moved forward is that royalty. So I think what we need to see in the U.S. and I could see this happening is these things need to be renegotiated with the DOE, and we need to get rid of some of these royalties if they're going to actually see this stuff come out of the ground. And in doing so, I got to think that to get creative, you've got a partner in the DOE. So it may be another source of financing, another way for the government to in the U.S. to support the the fuel they need and the exploration that needs to happen, or the development that needs to happen, is by getting in there and removing some of the barriers that are right now sitting between the people with the property and getting it out of the ground.
Interesting. I don't. That's always going to be, I guess, part of the equation. You can argue about whether it matters or not. I think, for me, every single cent matters, and I'd want the best kind of corporate structure possible. I'd want the best possible financial structure for the assets themselves. And we talked about a bunch of ways that people are financing this thing. And I think what we're saying is you got a choice of just sitting back and dying on the vine, or waiting for the market to kind of do you a favor, which case you're out of control. So someone else should be running this company, or just sit there and hunker down and don't spend any money. It'll be fine eventually, head in the sand. But I think I prefer companies that are going to kind of get out and try and do something. It may seem like expensive money today, but in a year's time or 2 years' time, maybe it'll look like genius. We've seen that so many times.
And the market's not doing the market's proven itself that it's not going to do us any favors this time around. We thought it would. We thought it might a few years back, but it's not turning out that way. So, companies that are going to pivot are going to make it.
One last one. Now, I've had a few CEOs approach me about, what about all this Middle East? I used to work family in the Middle East, and I've been approached by various groups, certainly off the back of this Saudi money, which is kind of coming into the sector, is going to save us. And I'm just going to say, time to wake up, guys. It's not going to save anyone. The Saudi money is going to be sent on Saudi projects. If you've got skill sets that you can bring to bear for Saudi projects, it's your lucky day. If you think it's going to save Canadian mining or American mining, wake up. It's not going to do that. Okay.
No. They're looking for offtake, as I understand. They're looking for if they're going to invest outside of the country, it's for the offtake, which means you've got to have something. I mean, few do.
And that's going to be some material which has some utility. So, like even gold, I would kind of question whether people want physical gold. There's some might, but I think a lot won't. This is all about this kind of green revolution that's happening over there to kind of get them past just oil. So uranium could be a big player in that. That's the good news. Again, we'll see what the Canadian government does, which is that's this conversation, paladin fishing thing. How does the Canadian government feel about any other government, out there at any one given time, and what pressure will be brought to bear by the US on the Canadian government to behave a certain way? Who knows? Can we talk about one last type of funding for me, which I thought was super interesting, which is off the back of these conversations about what the Saudis going to do, etc. Middle East money funds. That I've again been approached multiple times this year by groups saying, "Look, can you make some introductions into the Middle East with some family offices over there, with money over there, because we might be able to set up a structure of somehow, structured finance, very, very popular. So it's another way for saying bankers thinking their way around a problem and a way of enriching themselves. But if you can create some kind of mechanism which is, and position it in a way that this money understands how they will get a return, they're going to be all ears. So I'm a big pro fund structures, but then it comes down to who's running the fund, or who is working out the allocation of those funds and into what, right? Now, you and I, before this show started, we talked about it last week. We just maybe you have looked at this and you have had these sorts of conversations with groups. You say, look, I'm thinking of creating a uranium fund. Oh, it's easy. Let's go. It's not. There's a lot of variables in here. I mean, maybe you want to talk us through some of the things that you think.
Well, the big barrier winds up being into what, right? As we know, we could sit here probably and rhyme off all of the deposits on the planet that can be developed or are being developed right now. There's just not that many. So, you can put together 20, 50, $100 million and say, let's go get into the resource sector and put it in. But where are you going to put it? It becomes the issue. And you inevitably wind up looking at exploration again, which is a it is what it is. So if I've always thought that if you were going to put a fund together that was going to go out into the resource sector and invest in uranium at this stage of life, your best opportunities are going to be looking at exploration. But having said that, you got to go at it differently. You got to go at it like a venture fund. You have to go at it like a major would. That is, we've got an army of exploration companies out there, smart people, good geologists. They could be sitting on property that is of value that nobody's necessarily looking at, that they can't get any traction under. And it's not about going out there and earning in and buying up 80% of whatever they've got. It's a matter about giving them the alley-oop and easing money and expertise and whatever you can provide to help them along, and taking a reasonable piece of it, letting them win. But yeah, sprinkle a lot of seeds and sprinkle it carefully, sprinkle it properly. And when it's, when the project's not looking good anymore, you get out. So it's there. I think there is a way to go at it, but again, the difficulty is there's not that many places to place your bet in those advanced projects. There's no real good advanced projects that you're going to be able to create a portfolio around. And that's the challenge.
Oh, there's more challenges than that.
Well,
Come on. We've been talking about it for 5 years and beyond. Like I say, I was in the uranium space 2011. We offered Peninsula Energy $100 million, and Fukushima happened, and we basically, well, that was that. That was the end of that. That's the end of that deal, and my commission. But it's okay. I got over it eventually. But the thing right now is you realize that energy is and has always been a hot potato. Look at the oil. We go to war over oil all the time, and energy moving forward is going to be no different. I think uranium's final, that kind of political buy-in to uranium, or nuclear, I should say specifically, as a solution for our energy needs, and obviously feeding into this fervent.
Maybe this is why the new president of the United States keeps referring to us as the 51st state. Maybe
Nice.
they've got eyes on that.
Catchy.
Yeah.
Catchy.
We really appreciate that.
Really? I thought that was either Greenland or Ukraine. Or
he's been referring to our prime minister as the governor of the 51st state. So.
Oh, sorry, Canada. I thought you were talking about nuclear as the 51st state. That's a jump too far. Okay, so everyone loves Canada. Okay, but the point is that it's a kind of political hotbed, and that's kind of caused the timing around these investments. You look at Sachin Cove and the various other kind of uranium funds, uranium specialist funds that kicked off 2000, well, even pre-2019, 17, 18, and they went early, right? They went early. It was not, the script did not read.
But they're investing. They're investing in equities, right?
I know. I'm not. So I'm not. There's not criticism on them. I'm just
no.
saying
But that's what people tend to want to do. They get these funds and they want them to invest in the equity, when in fact that's not where you want the money to go. You want it to go into the project that you like.
Yeah.
And that's,
tell me more, because this is the sensible bit of the conversation. Because if it's equity investment, there's lots of things that companies get wrong with the asset. If it's good, if you bought into the right thing. Tell me more.
There's companies out there, and we can play exploration, or even development companies who've got other projects or all kinds of projects. But to invest in the equity just doesn't give you what you really need and what they really need. To be able to go in to a company and look at their portfolios, there's somebody to come in and look at our portfolio and say, okay, I don't care for these two, but that one's interesting and it deserves some money thrown at it. Let's do a transaction on that and move that one forward a little bit, and see whether it's got some legs. That makes more sense from an investment standpoint if you do it a bunch of times, rather than trying to again play the stock market.
Yeah. It's so I think if I was talking to, I have basically talking to these guys that want to kind of create funds, I say you gotta truly understand the thematic before you do. Don't see this as a jumping on the bandwagon thing. You will get it horribly wrong. So the thematic around nuclear and therefore uranium kind of feeding in is a very big topic, open and exposed to all sorts of political pressures, and we've seen black swan events like Fukushima. We've seen black swan events, I would argue, like COVID, and this whole energy and and what it did as a means of creating this energy transition narrative, and this fed into this anti-fossil fuel narrative and this East versus West energy, partnerships. It's complex. There's a lot of moving parts, and if you're setting up a fund expecting it to be nice, smooth sailing because nuclear is the way forward, I think you're in for a sharp shock. And if you're a pension fund feeding into that fund, you're probably not going to like it unless you are happy to sit and ride this thing for 10 plus years, right? And that's where we find ourselves. But I can see why people are drawn to this because they're desperate. Because conventional equity, as we've seen in the past, is not there for them. Certainly not now. And this is a broad statement, not just uranium, but elsewhere. It's been tough of recent years.
Well, certainly the energy and the nuclear narrative draw people to the space.
They do.
Absolutely.
Then, yeah, I agree.
And then reality kicks in.
Yeah, usually between your teeth. So look, I think it's one for patience. It's going to stop start. I think we're kind of finish on a tiny bit of macro at the moment. Obviously, we're kind of in the kind of mid to whatever high 70s at the moment. People expected more, but having seen $100,
it's the end of the year. There's been
it's fine. It's
something
fine,
like
folks.
50% less spot trade volume this year than last year at this time. So, I mean, the volumes are down. It's a small market. It's this end of the year.
Is that because there's more contracting? Why is that?
Because there's a lot more contracting. I think that's what's going on. We're seeing a lot more contracting. And even the stuff that is being traded, it's a few of the funds and a few of the producers just kind of picking up some cash here and there. But it's all small volume stuff. So I'm not getting too miffed about the price, although it is making people scratch their heads. But it's the spot price, and it's somewhat volatile. And right now, it's illiquid. So as things tighten up, we'll see where that goes.
Okay, we'll fit on a high.
Mm-hmm.
Congratulations to Wayne Hiley, Peninsula Energy. They managed to finish the end of the year. They're in production. Well done them.
There you go.
Came out this morning. Stock goes from 106 to 114, so not exactly a huge gain, but I think generally received positively and not the usual sell-off on good news. So well done.
Yeah.
Right, that's it. I'm done. I'm done for uranium for this year. I'm off.
Merry Christmas.
Thank you very much. Chris, just want to say, thanks so much for all your kind of input and commentary. I think a lot of people appreciate the conversation, the input, knowledge, etc. from you. And it's been sort of wide-ranging. We're not always uranium. We're a little bit broader than that. But yeah, there we go. Have a good one, sir.
You too. Ciao.